So Vinit, I guess you are very good at avoiding the red flags. And I recently read in your one of your investor communications that it is a 75% of your portfolio that rigorously aligns to your framework, whereas the 25% is more of a tactical allocation. Now, how do you take that tactical allocation? How do you avoid that urge to, hug momentum? What are the steps that you take there?
So even within the companies which are at any point in time not meeting the frameworks, um, there are very fundamental reasons at several points. So we witnessed the COVID-led business disruptions taking place, and we saw many businesses actually fell from their historical track records of growing at a specific rate which we look at. Many companies saw profitability led disruptions which actually meant that these companies within our various quantitative metrics, many quantitative metrics didn't meet. So there are times in the cycle where companies are also going through cycle, and we recognize that these are, let's say, short-term disruptions unless these are permanent damages to the business. And then we exercise patience to hold on to them, considering the fact that the core structure of the business has not got impacted, and the companies should revert back to mean once situation normalizes. So I think for a while it is possible that some businesses move out of the framework, and then we would like them to come back, and that's where a good returns can also be generated. There are times when we had identified a few of these specialty chemical companies when they were actually, frankly, out of my framework. I mean, in terms of their ROCs, they were single-digit ROCs, or capital employed was something which was very difficult to understand as to how things are going to pan out. But it actually was showing a lot of promise in terms of the growth prospects, the management's own internal decision, or the choice of getting to businesses which can generate superior ROCs. So those were clearly visible at that point in time. We felt that it is a good time in the cycle that we should allocate capital to these businesses, because as these businesses transform from single digit to double digit ROCs, which the management was showing very strong confidence upon, and good management, good clean management, we invested at that point in time. So we had looked at sort of turnarounds as well, and so when we are looking at those, we are definitely taking a call that these businesses are going to turn around, which can prove right wrong. But I think that's where many times the stocks are out of framework in those situations. But by and large, whenever we have taken decision broadly, some of the important metrics on corporate governance and capital allocation is something which doesn't get compromised. It is just that it is about how in the cycle these companies will sort of start reflecting the strong numbers which we are sort of looking at.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.